Hello everyone, welcome to chapter 15. This chapter is going to be split into two different videos, so this will be part 1. Let's get started. So this table comes directly from the textbook, and it's a good little summary chart because whenever we get ready to talk about these different entities, it's important to kind of understand the legal and non-tax aspects of these entities and then kind of compare them to the tax entities or the tax aspects of those entities. So from a legal standpoint, there are, I guess, 5 broad types of legal classifications that could be had. So we have our corporations, our LLCs, our general and limited partnerships, and I'll explain the difference in just a second, and our sole proprietorships. So general and limited partnerships. While both of those are partnerships, in a general partnership, all of the partners have unlimited liability with respect to the partnership's liabilities. Whereas in a limited partnership, those will have one general partner with unlimited liability for the partnership's debt and at least one limited partner that has limited liability only for their investment into the business. So I'll add these notes out here too. So all partners have unlimited liability and then unlimited partnerships. The general partner or the GP have unlimited liability. And then the limited partners, I'll abbreviate that as LP, the limited partners have limited liability. So in talking through the chart and some of the, I guess, more prominent non-tax characteristics for why someone might form a business in one way versus another, think about formally organizing. So formally organizing, you would have to have some sort of document present. So the entity types where you would have to do that are corporations, limited liability companies or LLCs, and limited partnerships. So each of those have their own special document for formally organizing. So a corporation, those are called the articles of incorporation. For a limited liability company, those are usually a certificate or articles of organization. And then for a limited partnership, that would be a certificate of limited partnership. And I believe general partnerships, they are not formally required to organize with the state, but it is recommended that you have a partnership agreement in place, just so then that could potentially help with explaining how income and losses are shared. So we won't get too far into that. That's more of a like advanced tax topic, but just something to think about, especially if you plan to study further into tax in the future. And so sole proprietorships, when we think about formally organizing, for the most part, the sole proprietorship has, I guess, an advantage because it's pretty easy to start a sole proprietorship. You don't have to formally file anything with the state in order to be recognized. So that's a pretty nice benefit. However, for this little asterisk, because I said in most cases, if you are wanting to form a single member limited liability company, then that you would have to formally organize. In terms of responsibility of liabilities for the business, if we kind of think about our sole proprietorships for a second, while it is a benefit that they're probably the easiest to start, a drawback is that all of the liabilities for the business fall to the responsibility of the owner. So if something were to happen in your business and someone tried to sue you, they could sue your business, but then they can also come after your personal assets too. In a general partnership or a limited partnership, the responsibility for the liabilities is limited just to the general partners. So that's why I kind of added the notes up above about the general partners. Because those general partners, and why that distinction is important, is because they have that unlimited liability. And so that's what ultimately makes them responsibility for the liabilities of the business. Whereas limited partners, their liability is also limited. That's what makes them a limited partner. Then if we go over to the LLCs and the corporations, thinking about who is responsible for the debt of the business, in those particular instances, it is the entity themselves. When thinking about the legal arrangements for the owners, sole proprietorships, they don't have any formal legal arrangement. So this doesn't apply to them. For all of the other entities that do have legal arrangement, LLCs, general partnerships, and limited partnerships, those are pretty flexible. If anything needed to be changed within that arrangement, the only downside, I guess, for the corporation perspective is once that arrangement is made, it is harder to make a change or an update to that legal arrangement. Then the last particular characteristic is whether or not it is suitable for an initial public offering or an IPO. So that initial public offering is whenever you want to start having your business and their stock to be traded on the stock market. In order to get into the stock market, you make an initial public offering. Typically, corporations are the only entities that can have that initial public offering. Because if we think about most of the businesses that are publicly traded on the stock exchange, a lot of them are these larger corporations. We're not necessarily seeing like sole proprietorships or small LLCs on the stock exchange. So now that we've started thinking about the legal aspects of an entity, now we can start thinking about the tax classifications for entities. So one thing that's important to note, and actually get my pen so I can make a note. So one important thing to note is an entity's tax election doesn't affect its legal classification. So it doesn't impact legal classification. Okay. Now I'm going to go through these bullets a little out of order, and I'm going to start with these two here. So for tax purposes, an entity can either be considered a tax-paying entity or a flow-through entity. And so the difference between those two is a tax-paying entity actually pays the tax as its own entity. So an example of a tax-paying entity is a C corporation. So C corporation. And they report their taxes on Form 11. 1120. A flow-through entity, on the other hand, is an entity that doesn't pay its own tax. Instead, that flow-through entity, it has that income or loss, and then that information flows through the business to the owners, and then the owners take that flow through income or loss in consideration with all of their other taxable income that they have. So some examples of flow through entities. We have S corps. So S corporations. And we see those on Form 1120 S, which makes sense because it's a corporation. That's why it's Form 1120, but it's an S corporation, so that makes it Form 1120 S. Other flow through entities, we have partnerships. Try to make that look more like an are there partnerships. And then those are on Form 1065. And then we have our sole proprietorships. Proprietorships. And then those are on the Form 1040. Schedule, sorry, oops. Sorry, that's supposed to say Schedule C, but it looks like a G. Let me fix that for a second. There we go, Schedule C. And these four here, so the C corporation, the S corporation, partnership, and sole proprietorship. These are the four main tax classifications. Some other things with tax classifications are check the box regulations. So what those check the box regulations mean, so it's going to be specifically related to these down here. So the check the box regulation is kind of what it sounds like. So a good example of that is related to corporations. So typically a corporation is automatically taxed as a C corporation unless they make a valid S election. And so I think it is actually a box that says like, hey, do you want to be taxed as an S corporation? And you can actually check that box to say yes. And there are specific rules that you have to follow to make sure you can make a valid S election. But that is more of an advanced tax topic. But just for general awareness, there are rules that you have to follow in order to make that S election. Other entities that can have check the box regulations are unincorporated entities. So for the most part, unincorporated entities are flow through entities. They start out as flow through entities. But if they have all of the right requirements, they can elect to be taxed as a C corporation. And then from there, if they really wanted to, they could even elect to be taxed as an S corporation. So let's go through a few example multiple choice questions based on what we just learned. So the first question, which of the following legal entities files documents with the state to be formally recognized by the state? I'll give you a few seconds to answer, or you can pause and think about it and hit play again. So if we think back to that chart on that second slide, A, a limited liability company, is an example of an entity that has to file documents with the state. And specifically, their documents are a certificate or articles of organization. Question 2. If an individual forms a sole proprietorship, which non-tax factor will be of greatest benefit to the sole proprietor? Again, I'll give a couple seconds if you want to pause and think about it. So the answer here is D. Takes minimal time and costs to organize. Because for most of the other entities, so corporation, LLC, and limited partnership, you have to file special documents in order to be recognized. In a general partnership, while you don't have to have formal documents, it is helpful to have a partnership agreement in place. But a sole proprietorship, since it's just you, the startup process can move relatively quickly. All right. Question 3. On which form is income from a single member LLC with one corporate or C corporation owner reported? Give you a second to think about it if you want to pause. So the answer for this one is A, the form 1120. And the reason why is because within this single member LLC, we have one corporate C corporation owner. So the C corporation owner. And C corporations are normally reported on the form 1120. All right, next question. On which tax form does a single member LLC with one individual owner report its income and losses? Give a second to think about it. So the answer here is D, the Form 1040 Schedule C. And the reason why is because it is a single member LLC, but it has one individual owner. And typically, individuals will report their taxes on the Form 1040. Last question. On which tax form do LLCs with more than one owner generally report their income and losses? Give you a second to think about it. And the answer to this one is letter C, Form 1065. And the reason why is because in this particular problem, it says it's an LLC with more than one owner. So if there's one owner, it kind of falls into that sole proprietorship realm. But since there is more than one owner and it's an LLC, that would make it a partnership. And partnerships are reported on the Form 1065. So as we mentioned earlier, tax classifications of entities can be split into tax-paying entities or flow-through entities. And that is helpful to remember because then that will help explain some of the more specifics of how to actually calculate the tax that that business is owed. So as we mentioned earlier, income generated by flow-through entities is taxed to the entity owners and not the entities themselves. So those sole proprietorships, partnerships, and S corporations, those businesses generate their income or loss, and then they are reported on an informational form. And then that data flows through from those informational forms into the owner's tax return. The tax-paying entities, on the other hand, so in this case, the C corporations, they pay the tax at the entity level. So for that C corporation, they'll take their taxable income, whatever it is, multiply it by their tax rate, and they have their tax. And it's also important to note that for corporations, there is technically a second level of tax that is paid, and that is at the shareholder level. And the reason why it's at the shareholder level is because occasionally corporations will distribute dividends. And usually the people that are receiving those dividends are the stockholders or the shareholders. And since those dividends are a form of income to those shareholders, the shareholders have to pay tax on those dividends that they receive. And we'll talk a little bit more about the specifics of that taxation in a later slide. So if we are wanting to know what a mathematical computation would be for taxes on business entities, starting with the flow-through entities, since those flow-through entities have the income or loss flow through directly to the owners, flow-through income is taxed at the individual's marginal tax rate since it flows from the business to the individual. So that tax rate could be as high as 37%, depending on what that individual's tax bracket is. Other potential taxes that could happen: passive investors, if that would apply to that someone, they could potentially owe 3.8% of net investment income tax. On top of that, owners of entities taxed as partnerships and sole proprietorships who are actively involved in the entity's business activities are potentially subject to 3.8 to 15.3% of self-employment tax and a 0.9% additional Medicare tax. So we'll talk about some of these a little bit more, especially the self-employment tax. Talk about that a little bit more in chapter 6. But for now, I just wanted to bring all of those up so that way it's kind of in the back of your mind that these extra taxes exist, especially for income on flow-through entities. Another calculation to consider for flow-through entities is the qualified business deduction. So QBI, qualified business income. So this we will definitely talk more about in chapter 6, but again, just mentioning it now so it's kind of in the back of your mind that this deduction is a thing. So what the QBI is and how it came to be was whenever the corporate tax rates dropped down to 21%, where they're at now, there was a disadvantage for people that owned business entities that were not a C corporation. So then this qualified business income deduction, or QBI, was created in a way to try to provide an advantage for flow-through entities. So that way there was kind of some fairness amongst the flow-through entities versus the corporate entities. So what QBI is, it is a from AGI deduction, but not an itemized deduction. And whenever we get to chapter 6, we'll kind of explain in greater detail what that difference is. But high level, what it is we're taking 25% of the qualified business income. And so that business income comes from non-service activities other than architecture and engineering. It must be income earned in the United States, and there are extra limitations that apply to this QBI deduction. Flipping over to the C corporation perspective and how that tax is calculated. So corporations will pay that entity level tax at 21%. So it's that new flat tax rate. And then here we're going to circle back to that second level of tax that the shareholders pay. So shareholders can receive dividends or they can sell stock. And so whenever those activities happen, the shareholders will pay that second tax of 0, 15, or 20%, depending on their income level. And I think we'll revisit this topic a little bit more. I want to say in chapter 5 is all about gross income. So we'll most likely be revisiting this topic in greater detail. So that way you can see like what income level qualifies for the 0%, 15%, or 20% tax. And they're sometimes referred to as the preferential tax rates, to try to encourage you to invest in companies because the government sees that as a positive activity to do. So there is that second level of tax that the shareholders potentially have to pay. And then on top of that, depending on your income level, there's also potentially a 3.8% net investment income tax that will have to be paid. An important tax characteristic to think about for entities is the owner compensation. So for sole proprietors, they have no compensation. And it's because that entity of that business is essentially can't remember if I said entity of that business or income of that business. I meant to say income of that business. I can't remember for sure. But the income of that business is the income of the individual. So that's why there's no compensation, because it's seen as one and the same. For S corporations and C corporations, there is the employee compensation, so salary and wages. And it is subject to FICA, so Social Security and Medicare, the employer and employee portions. And it is deductible by the entity, but it's not eligible for QBI deductions. So that QBI piece is specifically for the S corporations, since QBI is for flow through entities. Then for owners of entities taxed as partnerships, that compensation appears as a guaranteed payment, and they also have self-employment income. So those particular pieces of compensation, they are deductible by that partnership, but those are not eligible for QBI deductions either. So this ends the first video for part 1. Please stay tuned for part 2. And in part 2, we are going to be looking at losses that can happen for taxable business entities. Thanks.